Alrighty. Thank you everyone for joining us today. The slide deck can be found in the handout section on your webinar toolbar. Please also use the question section on the right-hand side to ask questions throughout the presentation. We will be holding and answering questions for the end of the presentation. We are also going to be sharing the slides and the presentation video recording link following the live presentation via email. And I'll pass it over to your presenters today.
Thank you, Allie. This is Frank Boudelet. Hello, and welcome to the latest updates on the stimulus package. Next slide, please. Our disclaimer that we always have is, the content is for general information only. You should not use this as a substitute for individualized tax advice with a qualified tax advisor, which may be us. This content represents the views of the authors or the presenters and does not necessarily represent the views or personal advice of Witham Smith & Brown. So it's our interpretations. Next slide, please. So today's presenters are myself. We have Dan Mayo, Matt Walsh, and Lou Young. So we, as a team, we've been putting a lot of these webinars on over time. Hopefully you all have heard from us. We have in Witham, we have a full team that has been dealing with this since, and it's actually been 10 months to the day since Bill Hageman reached out to me in March and said, Frank, we need to look into this SBA thing to see if this is going to be big and we can help our clients with. Reached out to Matt, and the first thing Matt said to me was, Frank, we need a bigger boat. So then we started reaching out to more help within the firm, Lou and Dan, and there's about 25 others behind the scenes that help out. We have meetings, calls at least twice a week, sometimes 3 times a week, to go over the latest and greatest that's out there. We will kick around questions that we get from our partners. So the partners that are on the call here and any managers from Witham that are on the call, thank you for sending those questions through our internal portal. We do take those questions. We will internally discuss them and try to get the answers out to the partners who then turn them over to the clients, and or we can get in touch with the clients that are on this call. We do kick them back and forth because, as you'll see and as you've seen over the last 10 months, the information put out by the SBA is kind of confusing. It's confusing to us, and we're dealing with it for 10 months. I can't imagine what it's like for you, trying to understand and interpret what the rules are. I see we're getting a lot of questions in already, and I think all of them we're going to answer, so that's a good thing. And we also have on our website, we have our stimulus package headquarters that you can find on our website. We have a lot of excellent articles that are written. One will be going out today. We have some on like the employee retention credit. There's a nice article on that. There's some more on some of the tax rules around this, as well as some of the things we're going to talk about today. So we're continually putting out information for you to use. We also, in our team, we have about 2,000 clients that receive PPP1 money. We helped many of them get the loan in the first place back in April and May. We are now working on the forgiveness calculations for several hundred of them currently. And trying to decipher the rules and make sure that we're applying them appropriately. And now PPP2 is coming out, which this is what this will talk about today. You can go to the next slide, please. So on December 27th, the president signed into legislation the Consolidated Appropriations Act of 2021. And this is $1.4 trillion was appropriated, the pandemic relief of more than $900 billion. And there's various tax provision and extenders, some of which we're going to talk about today. Since December 27th, what have we been doing internally? Well, we've been reading all of these releases by the SBA, and there's a list of all of them. Right from January 6th, when we got the acknowledgement our legislation changed from PPP expense disallowance. So that's a big one. We got a lot of questions on that. We will talk about that today. And you can see all the way up until January 19th, some new forms came out. Some new IFRs came out on forgiveness and how to handle some of the forgiveness calculations, also discussing how you apply for PPP2 if PPP1 is still open. So we will cover all of that information in this presentation. The presentation should last about an hour or so, and then we're gonna have about 45 minutes or so of questions. So we will get to all these questions. I believe a lot of the questions will be answered as we go through our presentation, but anything that we haven't answered, we'll bring at the end. We'll try to end around 12:45 to 1 o'clock, somewhere in that time range. So sit back and enjoy, and keep the questions coming in. Thanks, and I'll turn it over to Matt Walsh.
Hey everyone, hope everyone's doing well. First thing that we're going to do today is we're going to talk about changes to the PPP and talk about the reopening of PPP1. Next slide, please. So as we know, the legislation made some changes to the Paycheck Protection Program that do retroactively apply to any borrowers who have not applied yet for their forgiveness on the first loan, as well as going forward. The first thing, which seemed nominal at the time, but definitely has some big reaching implications, is that they have redefined the covered period such that the borrower now has the option to select their covered period between 8 weeks and 24 weeks. So if we think back before the CAA, we had an option that a borrower could either select an 8-week or 24-week covered period. There really was no in between, right? So although they had offered an administrative convenience that borrowers could apply before their covered period ended, we were really stuck with this idea that a borrower either selected 8 weeks or 24 weeks, and there wasn't necessarily an in between there. Now, a borrower, for anyone who has not applied for PPP1 loan forgiveness or anyone who is receiving a PPP2 loan, can select their covered period. So anytime between 8 weeks and 24 weeks is their selection. The one caveat here is that the proration of cash compensation at the individual employee level still stands, right? So, and what I mean when I say that is that, you know, the $100,000 cap still stands, and you would have to prorate that to whatever you decide your covered period is. So as a business owner, if you say, okay, I only need 16 weeks to get to my full forgiveness, you can use a 16-week covered period, and you would limit the cash compensation to 100,000 divided by 52 multiplied by 16, or $30,000. This is important for borrowers who are contemplating using multiple different programs within the same year. So for example, the employee retention tax credit that Dan's going to talk about later. Other situations may be that a borrower had a substantial decline in FTE headcount after a certain week, right? Then you could cut off your covered period before that and ignore that reduction. So there are a few different implications for this covered period switch. Next slide, please. The next thing that the legislation changed was that it expanded the definition of allowable and forgivable expenses. If you recall back, we had what expenses were allowed to be forgiven, and then what expenses, we're allowed to spend the PPP funds on, and then what is forgivable. And this was the change here was actually long signaled by Congress. They were originally talking about this back in August when they were thinking about extending the PPP, and this ended up making it into the final legislation of the CAA. So what they did was they expanded both the definition of payroll costs and non-payroll costs. So payroll costs, the expansion was slightly more subtle. It was definitely smaller, and it expanded the definition to include group life, disability, vision, and dental insurance. These are all things that the SBA had signaled to borrowers that they would be includable anyway, but they were never legislatively allowed. So the definition now for payroll costs includes group life, disability, vision, and dental insurance. And for those of you who are thinking about applying for PPP2, this is also important to keep in mind because payroll costs is the base there. As far as non-payroll costs, the non-payroll cost definition, which previously included only interest on mortgage obligations, rent obligations that were in place as of February 15th, and utilities that were in place as of February 15th of 2020, are now expanded to include 4 new categories. So those 4 categories, and just to keep in mind, the 60-40 split doesn't necessarily change. So you still need to have, when applying for loan forgiveness, 60% be towards payroll costs and 40%, a max of 40% towards non-payroll costs. But the non-payroll costs are now expanded to include 4 new categories. The first is covered operations expenditures. This was an area that we had heard a lot about of, could we include this software cost or payroll processing costs and stuff like that? And unfortunately, the answer was no for the longest time. But now the covered operations expenditures includes any payment for business software, cloud computing services, any software that facilitates business operations, product or service delivery, payment and processing of payroll, any human resources software, sales and billing function software, or inventory management software. All that stuff is now includable as a forgivable expense. The second category is covered property damage cost. So if the business had sustained damages due to vandalism or looting from public disturbances during 2020, and that those costs were not covered by insurance, those could also now be included as non-payroll costs. Next slide, please. And then the other 2 categories are covered supplier costs and covered worker protection expenditures. So covered supplier costs includes any expenditures that were made to a supplier that are essential to the operations, right? Provided that the contract or the purchase order was in place at any time before the covered period. And if those supplies are perishable goods, it would be included for any contract in effect at any time during the covered period as well. So this is a fairly broad definition, and we haven't gotten too much by way of explanation from the SBA on what could or would not be included here. But at its face value, it seems generally pretty broad. The final category is something that we are seeing a lot of, and this was something that was that Congress and Congress members had been talking about for probably going back to May or June of last year, about including worker protection expenditures due to COVID in the PPP forgivable costs, and now it's allowed. So what's included in covered worker protection expenditures is any operating or capital expenditures to facilitate the adaptation of business activities to be compliant with any guidance from the CDC, any guidance from OSHA, any guidance by state or local governments. Now, when they released the new applications, the one caveat with worker protection expenditures is that they are looking for borrowers who are claiming this from a loan forgiveness perspective to tie the expense to the COVID guidance, right? So they just want to make sure that you are using the items towards making the business compliant. And there is a list of capital expenditures that would be includable here. Generally speaking, if you think about adapting your workspace to a COVID-friendly environment, or installing air filtration systems, or if you have an office space, adjusting the workspaces for, to become to be able to have people in the office and still keep them socially distant, then that stuff is generally includable. And again, these changes are for Ppp2 borrowers or Ppp1 borrowers who haven't applied for forgiveness yet. Next slide, please. All right, so the other thing that the legislation did was it reopened the first round of the Paycheck Protection Program, and it earmarked $35 billion to fund this amount. So borrowers who did not take advantage of the original PPP1 funding can now go back and apply for a loan. If you are now looking to apply for a loan for the first time, you have to start with PPP1, and then you would, before you could get PPP2. So if you didn't receive a loan the first time and you are interested in receiving one, you would go back and get PPP1 first with the lender, and you would be subject to the rules and the eligibility concerns around PPP1. Next slide, please. The other thing that we get a lot of questions around is, can borrowers receive more money from the PPP1? So there was a lot of confusion early on in the process, and because of that confusion, certain borrowers were able to include expenses that certain borrowers were precluded from including expenses that otherwise would have been eligible. There was confusion around what the owner compensation rules. There was confusion around a myriad of different provisions in the law, and as a result, some borrowers were shorted funds. And the Congress, in writing this law, recognized that and said, hey, look, if you are in a position where you didn't get enough funds because of you know, because of a misunderstanding, you can go back and apply for more. There are a couple other situations in which you could also apply for more. The first is that if you returned all of your money, you know, due to some guidance that was issued, or you didn't take the full amount because you were forecasting out and you were saying there's no way I can spend this over 8 weeks, which at the time was the threshold for when you needed to spend it, then you could, in theory, go back and get more money. And then finally, if interim final rule that was released after you got the funds caused you to become eligible for more funds than you actually received, you could go back and get the money again. So the application process for this is made through the original lender. So you would need to talk to your lender about their process for this. We are hearing there's still some difficulty with how this is actually going to be administered. So definitely keep in touch with your lender. The one thing that we should point out is that if you are trying to get PPP2, which Lou is going to talk about here in a few minutes, you have to certify that you have spent all of the funds from PPP1, including any increase. So if you do get an increase, you'll have to expend those funds prior to getting PPP2 loan. Next slide, please. So another thing that the legislation did was it delivered on a promise for a simplified forgiveness process. So for borrowers that have loans of 150,000 or less, right? And again, this is for borrowers who didn't apply yet for forgiveness under the first round, or borrowers who received the second round of funding. There's a simplified loan forgiveness application, the 3508S. So the 3508S was something that had previously been made available by the SBA for loans under 50,000. It has been repurposed and retooled to comply with the requirements surrounding what was in the legislation, which was that it's a one-page form, and that borrowers would namely be able to certify to their forgiveness and would not need to provide documentation. So what we have here is you see the signature, or the two certifications that a borrower is required to make. You will not need to submit documentation. You're certifying that you will also maintain that documentation in the event of an audit. Next slide, please. The only thing that's interesting when this form was released is there's a caveat in there that borrowers who received a loan of more than 50,000, so basically if you're between that threshold of 50,000 and 150,000, or borrowers who received 50,000 or less but have affiliates that put them over 2 million. So if you're in one of those two categories, right, you still have to account for the requested loan forgiveness amount if you had any reductions in your headcount or your salary and wages. So what's interesting here is that while you can still fill out the one-page application, based on the language that is in there, you'll still need to go through the motion of completing the calculation in the background and making sure that you would still obtain full forgiveness. You know, the language here does indicate if you can make those certifications that would put you into the easy form, you would be able to do that. And, you know, as a result, you know, you wouldn't necessarily need to do the full calculation. But if you can't make those certifications, then in the background, you'll likely need to do the calculation. So this is an interesting, this was an interesting development that we saw in the instructions to the 3508S form. Next slide, please. And then, of course, we also got a new form 3508EZ. So this is the form that is available to borrowers of any size, right? Provided they can make certain certifications. The new form, which was released on the Department of Treasury website, restates the certifications to get into the form. They aren't large. They aren't substantially or materially different from the original certification. The only change here that's notable is really that if you are using what was previously the quote unquote option 2, right, which was that you didn't reduce salaries and you didn't reduce headcount from January 1st to the end of the covered period, that the beginning goalpost there, that January 1st, 2020 period, did not change, but the ending date does change, right? So in order to use that same certification, that you didn't reduce the headcount or the average paid hours or the number of employees for PPP2, you would be looking at a period from January 1st, 2020, potentially until June of 2021. So it just makes that certification fairly more difficult to reach if that's what you had used for the first loan to get into the easy form. With that being said, that covers the changes as far as what new expenses you can include, the changes to the to PPP1, as well as some of the new forms. And I'm going to pass it over to Lou Young here, who's going to walk us through the Ppp2 program. Lou?
Great, thanks, Matt. So as we talked about at the beginning, the Consolidated Appropriations Act added $284 billion for the Ppp2 loans, which will be out there through March 31st of 2021, or until the funds are exhausted. The major item here, and we'll get into the eligibility in a second, but the Ppp2 program is definitely targeting smaller businesses than the Ppp1 program. Obviously, they're looking at an employee limit of 300 instead of 500. But there are other things that they're looking at to sort of make sure that they're targeting the right audience for this loan. You know, as Matt mentioned, there's a lot of parallels to the Ppp1 program. The Ppp2, or the Consolidated Appropriations Act, basically amended the CARES Act to just upgrade it, add some additional requirements, but the key points, the key provisions of the Ppp1 Act or program are still in the Ppp2 program. And one of those provisions that we talk about a lot is the certification with respect to economic uncertainty. You know, current economic uncertainty makes this loan request necessary to support the ongoing operations of an applicant. That's a key certification in both programs. It's something we'll talk about a little bit in addition to the other certifications. Next slide. So we talked about eligibility. Matt mentioned that you have to have had received the Ppp1 loan and spent that money, spent that loan on the qualified expenses that were provided for in the Ppp1 program. So you got the loan, you spent that money during the covered period, you now qualify for the Ppp2 loan. You don't have to have applied for forgiveness yet. You just have to have gotten a loan and spent the money already. So again, I mentioned before, any business that employs not more than 300 employees, and in addition, has had a reduction in gross receipts of more than 25% during any quarter in 2020 compared to the same quarter in 2019. So for any quarter, say second quarter of 2020, if you've got a reduction in gross receipts of more than 25%, you meet the first qualification to get the Ppp2 loan, the Ppp2 money. Now, there's special rules for seasonal businesses or entities not in business in 2019, and the affiliation rules from Ppp1 still apply. These apply for the employee number and the gross receipts test. But keep in mind, there are exemptions for the affiliation test. So if your business meets those exemptions, you don't have to worry about the affiliation test for either the employee number or gross receipts test. Gross receipts for nonprofit entities is defined to have the same meaning as the Internal Revenue Code section 6033. So what, that's fine, next slide. What entities are not eligible? Entities that are described in section 120.110, other than the nonprofit or religious organizations. These include financial businesses engaged in lending, passive businesses owned by developers, landlords, businesses located in a foreign country. Specifically, they also talk about not being eligible businesses that are concerned, that are primarily engaged in political or lobbying activity, or any business concerns with specific ties to either China or Hong Kong. Now, we talked about gross receipts, and Frank is the king of gross receipts, so I'm going to let him go through that definition for a couple minutes, and then we'll get back on some of the other criteria for PPP2.
Great, thanks, Lou. Yeah, gross receipts. Before I mention that, I saw a lot of questions coming in. I'm just going to say this, and I shouldn't have to, but PPP stands for Paycheck Protection Program, to protect the employees' paychecks. But whenever you're thinking about what expenses, always think first, it's to protect employees' payroll. Okay, so reduction in gross receipts, and I see a lot of questions on receipts. So the borrower must be able to demonstrate a reduction in gross receipts of 25% or greater in any 2020 quarter as compared to the same quarter in 2019. They do not define what a quarter is. We believe they're talking about a calendar quarter. So I know if you're on a fiscal year end, it might be different, but I believe they're talking about calendar quarters. Now you can compare. Now you also have the option to compare your full 2020 year, and the reason I say it's calendar quarters because they're talking about a full 2020 year versus 2019 year. If that results in a 25% reduction in payroll, in gross receipts, and we'll talk about the definition of gross receipts, you can use your full year. Why would you do that? Because you have to substantiate to the lender that you had a 25% reduction. So in that case, you can show them your tax return for the full year, 2019 versus 2020. And if the whole year is down, then at least one of the quarters have been down. Now, again, you only have to meet one quarter. But remember what Lou had mentioned earlier, there is a certification that current economic uncertainty makes the loan request necessary to support ongoing operations. That is as of the date that you apply for PPP2. So keep that in mind when you're thinking about whether you should be able to apply for PPP2. Now, you have to be in business as of February 15th, 2020. So if you started your business, or we've seen a couple of clients come to us where they split the business off in the end of 2020. That entity that's going to apply the EIN is not in existence as of February 15, 2020. We believe they cannot apply for PPP2. Now, if you're not in business for a full year in 2019, you compare whatever quarters you are in business for 2019 versus the same quarters in 2020. If your business started in the first quarter of 2020 or the fourth quarter, the very end of the fourth quarter of 2019, you would use the first quarter of 2020 and compare that to the other 3 quarters in 2020. So first quarter of 2020 is, $50,000 in revenue. You'd have to have one of the other quarters be 25% less than that in order to qualify for PPP2. Next slide, please. So the IFR came out on the 19th, which we're all wondering, what is this gross receipts? How do you define it? So they define it that it includes all revenue in whatever form received or accrued. I know we have a lot of questions. Is it accrual? Is it cash basis? And here it's either way in accordance with the entity's accounting method. Now I'm interpreting that, and I could be wrong, an accounting method. If you have a financial statement, that would be whatever method you use for your financial statements is the method you would use. If you have a financial statement and a tax return, you may have the choice of which one to use. And it's from whatever source, including the sales of products or services, interest, dividends, rents, and royalties, fees, and commissions are all included in gross receipts. You can reduce it for returns and allowances. If you're on a cash basis, I'm not sure you get to take an allowance for returns on a cash basis. So take that into consideration as well. It does exclude any capital gains and losses, as those are reported separately in IRS forms, and it should not include any taxes collected. So if you're collecting sales tax, you would subtract that from, so if you collect I don't know, New Jersey, 7%, I don't remember what it is now, but if you collected $107, only the $100 would be included as your gross receipts. The 7 is you're just Lou, are you raising your hand?
Yeah, just keep in mind, if you did take your PPP loan into income for 2020, it does not include the PPP loan proceeds if you took them into income, just FYI.
Right. The PPP loans are not included as a revenue item. And we have a whole other slide, a seminar we did on the accounting for this, for accounting purposes. And if you need that, I think we have it somewhere on our website. You can find that. Next slide, please. So now for gross receipts for not-for-profit entities, which we have a lot of not-for-profit entities calling about this, and they've defined it as the gross receipts has the same meaning as gross receipts within section 6033 of the Internal Revenue Code of 1986. So what does that mean? It includes, but not limited to, and I love when they give that definition. This is all the items, but not limited to these. Gross amount received as contributions, gifts, grants, and similar amounts without reduction for expenses of fundraising or collecting of such amounts. So if you get a grant, if you have a nonprofit that gets grants, those grants are picked up as gross receipts. Also, gross receipts as dues, assessments from members or affiliated organizations, because now 501c6 associations can apply for PPP2. Sales receipts from business activities, including business activities unrelated. So that's when you have your 990T, that counts. Gross receipts from the sale of assets without reduction, which is a little different than you saw for-profit entities. You have a sale of an asset, a capital asset, you didn't have to include it. Here you are including it. And gross receipts from investment income, interest and dividends, rents and royalties. That is all what is included in the gross receipts. So again, I know we have a lot of questions on this. When we get to those, we'll try to answer them. But hopefully we've answered most of the questions here. And that 25% reduction, we've had questions. What if it's 24.2%? I think you're rounding down. If it's 25.8%, you could round up and say it's 24.8. It rounds to 25. Again, you also have the other caveat, the other certification that you have economic uncertainty. So keep that in mind when you are looking at PPP2. With that said, I'll turn it back to Lou to take us through the loan amounts. Lou, take it away.
Okay, next slide. Thank you.
Yeah.
Thanks, Frank. So the maximum loan amount is calculated as follows. It's the lesser of 2.5 times the average total monthly payroll costs incurred or paid by the entity during either calendar year 2019 or 2020. We've gotten many questions on this. You can use 2020, so keep that in mind as you're going through this. And as I said before, it is capped at $2 million. So these loans cannot exceed $2 million. Now, for NAICS codes starting with 72 that were hit especially hard, examples are restaurants, hospitality industries. These industries, these codes get to use a 3.5 multiplier instead of a 2.5 multiplier, but they are subject to the same $2 million maximum, adding a couple zeros there. The corporate groups are capped to $4 million across all entities. The next slide. So now we're getting into the small print aspect of this presentation. So generally, as I mentioned before, many of the requirements from PPP1 are the same as PPP2. And just to refresh your memory, what you're doing, the first step you're taking is to calculate your payroll costs either 2019 or 2020, and you start with your 2019 IRS Form 941, taxable Medicare wages and tips, and you would be adding that up all 4 quarters to get to your total. To that, you would be adding your any pre-tax employee contributions for health insurance or other fringe benefits excluded from the taxable Medicare wages. So this might be insurance, life insurance, or FSA, other programs. These were not included in the first PPP1. So that is the slight difference in terms of calculation. So if you're going back to your original loan, looking at your calculation for your loan amount, there could be a slight difference, but for the most part, if you're using 2019, it will be very, very similar. And again, there's limitations on any gross wages for employees who exceeded $100,000. So any wages would be limited to $100,000. And again, group health, life, disability, vision, dental insurance contributions, employer contributions are added in, as well as retirement contributions and state and local taxes. Okay, so once you combine all these to get your payroll costs, you calculate the average monthly payroll and you multiply that by 2.5. So you're taking the average monthly payroll cost and you're multiplying it by 2.5. Again, very similar to what you did in the first PPP program. Next slide. So one thing we just wanted to go over quickly is the payroll costs. Again, everybody should be pretty familiar with these as they're very similar. So it's salaries, wages, commissions, other similar compensation, cash or cash tips or equivalent, payment for any PTO time that you're taking, and any group health care or group life, disability, vision, or dental insurance. And again, this is including insurance premiums, as well as retirement and the state and local taxes for the employees. Independent contractors or sole proprietors, we're including wages, commissions, income, or net earnings from self-employment or similar compensation. Next slide. So looking at the loan itself, the terms are slightly different. If you do not apply for forgiveness or do not get forgiveness, it becomes a 5-year loan at a 1% interest rate. No collateral or personal guarantees are required. We talked about the certifications before. Frank went into detail on the gross receipts reduction requirement. Again, you can't have, you have to have more than 25%. You have to have more than a 25% reduction in gross receipts for a given quarter, comparing 2020 to 2019. That's on the front page of the application. But there's a couple notable certifications that you do have to make. And again, we've been talking about this economic uncertainty certification quite a bit during this presentation, and certainly over the last couple of weeks, responding to questions that we're getting from our clients. It's very important to focus on this because you know, we're in a much different time than we were last March when we were doing this initial certification. And you want to make sure that you're comfortable certifying that you do need the money and that you believe that economic times are what they are, and there is certain uncertainty. How's that? To the fact that going forward, you may need this money. There is another notable certification I wanted to mention, and that is that you have to use this money to maintain your payroll and retain employees. So those are two key certifications on the form that you should be paying attention to and making sure that you can in fact check those boxes. As we mentioned before, you have to have used the PPP1 loan for eligible expenses prior to disbursement of PPP2, and the applicant will not receive a shuttered venue operator grant. Now, application forms are available for both the original PPP1 program if you have not applied to date, or if you have applied and you want to apply for a second draw, those application forms are available through the SBA website. Right now, as of Tuesday, many of the banks have their portals up and you can apply for the second round. The second draw application is available online. There are some banks that have suspended the forgiveness application for PPP1. So don't be surprised if you can get in for PPP2, but the application for the forgiveness of PPP1 is not on there at this time. It may have been suspended. My understanding is that it should be up and running pretty soon. They just wanted to deal with the onslaught of the second round applications. Next slide. So I think we just want to touch briefly on the EIDL program. So under the new program, under the new Consolidated Appropriations Act, the Congress came out and clarified that you no longer have your loan forgiveness amount reduced by any of the EIDL grant money. So if you got $10,000 in a grant from the program, from the SBA, originally that had to be paid back as part of your PPP1 loan program. It would not have been forgiven. Under the new law, under the new legislation, that amount is now considered to be part of your forgiveness. You don't have to separate it out as a separate loan. So if you've gotten your forgiveness already, you should be touching base with your borrowers to make sure that it's clear that you don't have to pay that EIDL grant money back. So you should be talking to your banks at this point if you've gotten your forgiveness already and you had an EIDL grant. So a couple things we wanted to mention. The Congress is definitely looking to target a much smaller group for this program. You have to be able to qualify that you were in a community that suffered a loss of 30% or more. Again, that's defined as an 8-week period between March 2nd, 2020, and any 8-week period between March 2nd, 2020 and December 31st, 2021, as compared to the comparable 8-week period before March 2nd of 2020. So again, entities that have received a portion of the 10,000 will be made whole. Now, one thing that came out last night to our attention is that the SBA is going to be contacting anyone who they think qualifies for this. So this is in the category of don't call us, we'll call you. So the SBA is planning to reach out via email to those who may qualify to confirm eligibility. Priority will be given to those who received the partial EIDL advance and those who applied before December 27th, 2020 and did not receive an advance due to a lack of funding. Only prior applicants will be considered for the EIDL advance. So there have been some changes very recently. You may want to stay tuned as there may be updates on this, but for now, the SBA will be contacting any entities that they feel will be eligible for this program. Okay, so with that, I think we'll turn it over to Dan and he can spend a little bit of time talking about where we are with the tax aspect of this.
Thanks, Lou. Thank you for that. And great to see you coined the phrase certain uncertainties.
Yes,
Rumsfeld had known unknowns, and now when your book comes out, now we know the title.
Certain uncertainties.
Okay, thanks. So we're going to start with the tax piece here with what the headline, which is the PPP loan forgiveness is now completely tax-free. So that's good news. It's consistent with congressional intent, and Section 276 of the Consolidated Appropriations Act is what does it. And they reverse legislatively the IRS's position in that notice 2020-32 and their revenue ruling 2020-27. So deductions relating to loan forgiveness will be allowed in full, and borrower's tax basis and other attributes will not be reduced as a result of loan forgiveness. This does apply retroactively, so it applies to every borrower of a PPP loan, PPP1, PPP2, even if you got forgiveness before the statute was passed. So the IRS then, after the statute came out and set new law, the IRS sort of confirmed the law and they acknowledged it by issuing that revenue ruling 2021-2, basically just saying that we realize the law has changed, so we're obsoleting. That's how they withdraw notices and revenue rulings. They obsolete it, and so they took away that notice and revenue ruling, so it's now completely tax-free. EIDL grants, the same treatment. Recall that's the grant that Lou mentioned, up to $10,000 per taxpayer. That also is completely tax-free now. No expense disallowance, no income. And same thing for grants for shuttered venue operators. So we have a large theater and theatrical industry practice here at Witham, and so we spend a lot of time with these shuttered venue operator grants. Those are now tax-free. Same as certain SBA loan payments. They provide relief for, I think, 6 months of loan payments, and that will also be tax-free. There's a couple others in the statute too that are smaller ones we just didn't mention here. Next slide, please. So the only question lingering now about the tax-free nature and no expense disallowance for the PPP loan forgiveness is, when does it occur? And so when does a borrower get to increase its basis if they're a partner in a partnership or a shareholder in an S corporation? And that basis increase is going to be important to determine whether they have income or loss income on distributions, or losses can be used by the taxpayer to the extent of their basis. So the question really, and we put that in that second black bullet, is when does the borrower recognize a tax-exempt income? Is it when the loan application forgiveness application is filed, or is it when the borrower receives a decision from its lender? And there's no answer on this. But so I put together a little example here just to show the stakes and what's involved here. And so we have a sole shareholder of an S corp, has no outside basis at the beginning of 2020, and in 2020 he has 100 of income, 100 of expenses, so zero taxable income, and he files a PPP loan forgiveness application for the full amount of its $200 loan. So there's there's no taxable income in 2020. He still hasn't received a decision by the end of 2020, hoping to get it in 2021. So if the shareholder now receives the basis increase when the decision from the lender is received in 2021, then his basis at the end of 2020 is zero, and that's important because the distribution of that 200 in 2020 will be taxable as capital gain. If, however, the shareholder gets their basis increase in 2020 when they file their application but still have not received a decision, then their basis will have increased by 200 at the end of the year, and that distribution will be tax-free. So we wanted to show here how it can affect someone not getting the basis increase as a result of the income, result of the tax-free income. So when is it increased? Again, it's not clear. We're hoping the IRS will come out with guidance, but they did issue that prior revenue rule in 2020-27, which has been obsoleted. They talked about when does expense disallowance occur, and the decision they made there was it occurs in 2020 if at the end of the year the borrower had a reasonable expectation of forgiveness. And so we don't know that standard is going to apply here for the recognition of tax-exempt income, but hopefully the IRS issues guidance on this point in the near future. Next slide, please. And so now we're going to talk about some other tax provisions that were in the CAA, starting with the Employee Retention Tax Credit. And so before we get into the new Employee Retention Tax Credit, let's just take a one-slide review of the credit as it existed last year. So we know it came in as part of the CARES Act on March 27th. It was a fully refundable credit equal to 50% of wages paid between March 13th and the end of the year to employees, for wages paid to employees up to a maximum amount of $10,000 in wages per employee. So if it's a 50% credit up to $10,000 in wages, the maximum credit is $5,000, as we show there in the third bullet. Before this Consolidated Appropriations Act was passed in December, taxpayers could not claim the Employee Retention Tax Credit if they obtained a PPP loan. That was right in the text of the CARES Act. That now is gone. That requirement's been eliminated, as we'll see. We'll talk about it on the next slide. But I want to mention 3 more points here. The employers can claim the Employee Retention Tax Credit by reducing their employment tax deposits. If the amount exceeds it, they can receive an advance payment from the IRS by filing that Form 7200. And the taxpayer will make a year-end reconciliation on their Form 941 to reconcile the amounts paid. So that's sort of the basic operation of last year's ERTC. Let's talk now on the next slide about the new one and the comparisons. So what did it do? The CAA, it extended and expanded the ERTC. So let's see what that means now by looking at some of the details here. And so it extended the wage period. So it now applies in 2021 to qualified wages paid during the first 2 calendar quarters of 2021. So January to March is the first one, April and June is the second quarter. It cuts off anywhere, it stops July 1st. So it also, as I mentioned before, the CAA, it lifts that ban on claiming the ERTC if a taxpayer also got a PPP loan. And most important for everyone is it's retroactive. So this is a very significant change. This opens up an opportunity for every borrower who received a PPP loan now can go back and amend the return for 2020 and assess whether they are eligible for the Employee Retention Tax Credit. So big opportunity here. There's two things I hope you take away about the ERTC, and that's every borrower needs to consider whether they get a credit for the first 2 quarters of 2021. That's the prospective credit, and also they need to look retroactively for 2020 and see whether they qualified if they got a PPP loan, because it usually most people never even went through the analysis because they knew the PPP loan was a better option. It provided 2.5 months of wages versus $5,000 on the Employee Retention Tax Credit. So for the vast majority of people, the better option was a PPP. And then once they heard they couldn't get the Employee Retention Tax Credit, they just never considered it. So it will be a new thought process for many people to go back and say, did I qualify? We'll talk about the requirements on the next slide, but also there's no double dipping here. So you cannot receive the Employee Retention Tax Credit on wages that were also gave rise to forgiveness on the PPP. So this is, practically speaking, I think this is a matter of creative accounting and to make sure, and just keeping track of things, to make sure that the wages you use for one were not the same wages you use for the other. For most people, this shouldn't be a problem. They should be able to take advantage of both without double dipping. That's why I say it's just creative accounting. I don't mean to do anything funny or inappropriate. Just that it's just a matter of keeping track of the wages and saying, well, these 3 months were the PPP and these 3 months were the Employee Retention Tax Credit. The Act also increased the credit percentage and per employee limitation. So the 2020 ERTC is 70% of qualified wages as opposed to 50%, and it's 70% per quarter, not just the whole year 2021. So you get 70% of 10,000 in Q1 and 70% of 10,000 in Q2. That's a change, because last year it was 50% of the wages for the entire year. So even though in 2020 the max credit was 5,000 per employee, in 2021 the max credit is 14,000 per employee. So 7,000 of wages in the 7,000 of a credit in the first quarter and 7,000 in the second quarter. So that's why we mentioned it expands the credit, not just extends it. It does both. Next slide, please. So again, continuing on the expanded eligibility on other features of it, in 2020, the ERTC, there were two sort of tests to get in disjunctive. You only need to meet one or the other, but two tests. One is there's a partial or full suspension of operations. And two, they required a substantial, meaning more than 50% decline in gross receipts. These rules are changed in 2021. So the first test is the same. You qualify for the ERTC this year if you have a partial or full suspension of operations. That still works, but the 50% was reduced to 20%, making it much more favorable and easier for people to qualify in 2021. So you look at quarter-over-quarter gross receipts, so the same quarter in 21 versus 2019. That's a quirk, right? It's they're trying to check at pre-COVID comparison, which is why they go back to 2019. There is an election here where the employer can elect to use the prior quarter's gross receipts. So just the way this works, if you're testing Q1 eligibility, you can use the prior quarter, which is Q4 20, and then you compare that to Q4 2019. And then there's some special rules here, but gross receipts is what I'll focus on. That means gross receipts as defined in 6033, which is a very broad definition that applies to tax exempt entities. As Frank mentioned for the PPP, the definition for the tax definition is equally broad. Another significant benefit in 2021 is that they increased the hurdle for qualified wages, now 500 employees instead of 100. So what does that mean? In 2020, the ERTC, the way it worked was qualified wages was up to 10,000. If you had 100 or fewer employees, it was 10,000 for every single employee you pay. If you had more than 100 employees, you only got to include the wages of the employees who are not providing services during the suspension or decline in gross receipts, meaning you only got to receive the employee retention tax credit for employees who you're paying and they were not able to work or telework. That's now changed, which makes it much more favorable for smaller companies between 100 and 500 employees. If you're under 500 FTEs now, it covers all wages in 2021, every single employee you have. So that really does, one, it expands the base, it makes the credit more valuable, and two, it makes it easier to keep track of qualified wages if you're under 500 employees, because you don't need to keep track of who's doing what. It's just a matter of, are you paying them in 2021? And if the answer is yes, you receive a credit of 70% of their wages, up to 10,000 each of the first 2 quarters. Next slide, please. There's some special rules here. I'll go through these rather quickly just to save some time for questions at the end. I know I see a tremendous amount of questions, and we've been answering them along the way, as you'll see in the. If you check your question, there's a good likelihood it's been answered already. So large employers, meaning over 500 FTEs, average FTEs, they cannot obtain an advance payment of the employee retention tax credit in 2021 like they could in 2020. It's a slight change. They can only be obtained if you're for under 500 or fewer employees during 2019, and even then, the advance payment's limited to 70% of the wages paid by the employer in 2019. So they're limiting who's getting this the credit sooner. It's just a timing issue. Group healthcare costs now count as qualified wages, even if no other wages are paid. This is a very helpful rule because it brings furloughed employees into the mix, right? A furloughed employee, while there were varying definitions, I think after post-COVID, I think people have a better sense now of what a furloughed employee is. I don't think most of us had clear understandings of what this meant, because I remember in early mid to late March, I was having discussions for webinars with payroll companies, and everyone had a different definition of what it meant to be a furloughed employee. It seems to have settled, although it's not definitive, but it seems to have settled on a furloughed employee is someone who the employer is paying their health care costs, but they no longer work at the company. They're not providing services, they're not being paid to work, but they are covering the costs of their health care. So those employees now, the health care wages the employer is paying can be used to obtain an employee retention tax credit. So 70% of those health insurance costs can count for the employee retention tax credit. And also that's retroactive, so you can get 50% of the wages that were paid in 2020. So that's a good thing. We put a link here. These under a lot of these, you see it says Witham article discussing the changes. It's underlined, which means we linked it. So if you have the presentation, hit Control. If the link doesn't work, hit Control and hold it down while you click the link. And so we hyperlinked a lot of these things to make it easy for you to find the underlying documents. So hopefully you find that helpful. Next slide, please. The qualified paid sick leave and family leave provisions of FECRA, which is that's that second stimulus legislation, the Families First Coronavirus Response Act. That was passed a week or two before the CARES Act in March. And that provided for qualified paid sick leave and family leave credits. It was 2 weeks of sick leave, 80 hours, and then 10 weeks of family medical leave. Excuse me. And so that has been extended through March. That it expired, and those credits are only available on wages paid through December of 20, December 31st of 2020. They've now extended it for 3 more months into 2021. And so that dollar for dollar credit for those wages is still available now. And the IRS has a website with a lot of FAQs, both on this provision, the qualified sick and family leave, as well as the employee retention tax credit. And what I always tell clients when they have questions, certainly reach out to us, but if they want to see the rules themselves, if you Google IRS FAQ and then paid sick leave or paid family leave, you'll pull up the list of their frequently asked questions that the IRS has. There's also, with paid sick leave and family leave, there's also the Department of Health has their own FAQs up. So that is also available to discuss what it means to be sick and out, what if your employer shut down. There's a lot of detailed rules on those 2 sites. Similarly with the employee retention tax credit, if you just Google IRS FAQ employee retention tax credit, the first item that comes up is the IRS's FAQs, and they're broken out by category, so you can easily reference and find the item you're looking for. Next slide, please. So here we have some miscellaneous tax provisions. I'll just focus on a few of them. There's a temporary allowance. The full business meals are 50% deductible. And so what the CAA did was in 2021 and 2022, the meals are 100% deductible. And this applies to meals that are eaten in the restaurant and also carry out and delivery meals. So it's not just meals that are eaten in the restaurant. There's 100% deduction now for these business meals, and that applies to food and beverage, but not entertainment. So entertainment is still not deductible. So if you're going to an entertainment venue and spending money on food and beverage, you need a separate receipt, or it has to be broken out. The cost of the food and beverage is broken out from the entertainment, and then the food and beverage piece will be 100% deductible if it's paid or incurred in 2021 or 2022. There's a charitable deduction here, that $300 charitable deduction that was for last year. Most taxpayers take the standard deduction these days as a result of the Tax Cuts and Jobs Act. Few people itemize. When you itemize, you're able to take charitable deductions. But for those people that take the standard deduction, they had a one-time opportunity in 2020. If you donated $300 to certain charities, meaning not individual charities like the Blue Cancer Society, but not people with special needs. It wasn't that. It was certain types of they excluded, I think, like donor funds, donor advised funds, certain things. But to most public charities qualified. But if you gave a cash donation to those charities, you received a $300 above the line deduction. So you could take the standard deduction and still get the charitable deduction up to $300. That was extended and expanded in 2021. So it was extended into 2021, so it applies to 21 as well as 20, and it was expanded, and by that it means there was a $300 maximum for single people, and if you were married filing jointly, it was also $300. They didn't double it. In 2021, it's now doubled if you're married filing jointly. So if each spouse gives $300 cash to a charity, they can take a $600 above the line deduction. Education expenses, you see there's a special rule there. Also the minimum low-income housing tax credit. There's some changes there. And the last one I'll mention is that they sped up the depreciation of certain rental real estate properties, now a 30-year period. So that's helpful from a 39.5-year period, speeds it up. And even if the property is placed in service before 2018. So with that, I'll turn it over to Frank, and he's going to continue on with the presentation.
Okay, questions. So, and behind the questions, we're not going to go there. We'll leave it here. There's some extra credit information, so that's just there for you to peruse. So why don't we just jump right into the questions? So thank you all for listening. I know some people dropped off when they found out this was no CPE for this. So I thought that was kind of interesting. But you know, there's plenty of opportunity to get CPE down the road. So one question I want to bring up it's down near the bottom, but I thought I'm an auditor, and I know we have a lot of audit partners on this call, and one person from our technical resource group. So the interesting question I saw was, how do you certify economic uncertainty? Signing financial statements with a question mark. So I thought about that and said, if you are saying that you have economic uncertainty, which makes this loan necessary to continue operations, do you have a going concern for your financial statement? It's a good point. I'm not sure how to answer that, except that, yes, if you are getting this loan, you know, and you're certifying that there's uncertainty in your business, you may have to make a memo to your auditor to let them know why you think you don't have a going concern issue. So I thought that was a great question, and thank you for asking that one. And I know my auditors on the call here are probably pondering that, have been pondering that for a while. So with that said, one other thing I want to mention, I did see a question. I kind of answered some of these questions, and I think everybody's been answering as we went along. Someone asked, he left, where's my check, and are you shaving before April 15th? The answer is, I don't know where your check is, and you probably make too much money, and no, I'm not shaving before April 15th. So this is my Corona beard, and until we open up the country again, I'm leaving it. So with that said, we'll move on to, can a fiscal quarter be used for the 25% or calendar quarters? And again, they didn't define that, but everything that they've written seems to be that's a calendar quarter. So they're looking at calendar quarters versus your fiscal quarter. Once we begin the application process, can we decide to withdraw our application? Yeah, you can call your bank and say, pull it. I don't want to apply. I'm not sure why you would pull the application. And then if you did get the loan, can you pay it back sooner than 5 years? Yes, the government would love to have your money back sooner. But remember, it's a 1% interest rate, so you may want to keep it. Has the IRS issued the guidelines on how to amend the 941 to get the ERTC?
Not yet. No, they haven't come out with that yet.
Popular question.
That is a popular question as we go through. Is there a specific procedure application for the borrower to use to have the lender apply for an increase in their PPP1 loan?
Yes, there is. There's an application on the website that applies for PPP1 loans and upsizing. The new application covers both.
But definitely reach out to your lender before filling it out manually, because they may have a specific process or may not be open yet to accept those applications.
And the quickest way for people, by the way, to get that, which I think we linked it somewhere in the presentation, if you type in Treasury PPP loan, that will give you all of the first hit that comes up is a Treasury website that has all of the documents relating to the PPP, including the applications, the IFRs, everything you need to know is on one page.
Right. And most of our articles do link to that as well. So if you see an article we have and we're linking, it's pretty much linking to that area. So if the link doesn't work, that's a good place to go. We use a PEO for payroll processing. Our bank wants us to submit 941s to calculate borrowing limit. 941s only show taxable income, not true gross. The PE uses true gross salary in their calculation. Can we use the PEO report rather than 941s?
Well, You're probably going to have to, because I don't think the PEO is actually going to give you 941s. Most PEOs are issuing letters to their customers saying, "Hey, we're a PEO. We file our 941s combined among all of our subscribing companies," which means that these 941s wouldn't mean anything to the specific borrower. So I think the reports that you get from your PEO for your specific company will do along with that letter. The lender should accept that.
I mean, depending on the size, you might want to do a check to make sure that, you know, the numbers are matching up with your W-2s that you have as well. So that's a check on your numbers.
All right. Question here was, they filed for forgiveness. The bank told them they submitted it 4 months ago to the SBA. Now, we know the SBA is supposed to turn these around in 90 days. Should we be concerned? I think Dan answered that question. It's hard to know the exact reason for the delay. I would check with the bank. I would check back with the bank, right? You guys agree?
Yeah.
Should be 90 days, but I mean, if the loan was over,
by the way,
yeah.
Frank, I have heard from an institution that they hear the SBA's decision the same time the borrower does. The SBA notifies them both at the same time. So it's probably not the SBA causing, it's not that the SBA decided and they didn't hear, it's just that they haven't gotten a decision yet.
Right. And if if the loan's over $2 million, that could be the cause of the delay, because they're probably asking for more information, and maybe somehow there's a mix up with the bank getting you the questions that you need to supply more documentation. The next question, how will this work for sole proprietor Schedule C as far as documentation of the covered period? So I guess the question is, there's a sole proprietor, how do they account, and even for partners, how do they support their compensation?
So for sole proprietors, you would use your previously filed Schedule C, right? So if you're applying for forgiveness on your first loan, you'll use your 2019 Schedule C, line 31, which represents your net income. The maximum amount for a sole proprietor that they could take is you take that number, you divide it by 12 and multiply it by 2.5. So that would be the substantiation for your owner compensation costs towards your forgiveness.
Mm-hmm.
Yeah, that's the same as last time around too. Same way you approved it last time. No change in that.
Okay, let's see, moving down, some more questions. How will PPP second draw handle the number of full-time employees needed to get forgiveness? What time frame will you need to look back on? For instance, in the first round, I think the options were, so the first round you had, you know, the February 15th of 19, the June 30th of 19, and the January 1st of 2020. Is that the same way for PPP2 when you're doing the look back on forgiveness for FTEs counts? Guys?
Yes. Yeah,
yes.
No change.
That was my question to you guys. I wasn't answering it.
Oh. No change.
No change. We believe it's exactly the same. Again, the point of this is that the issue was, did you have, you know, were you impacted when the virus started, which was back in March? So you're always going to be comparing before the pandemic occurred toward the pandemic. So I might skip over some of those questions that we get to in that area, but that's pretty much what they're looking for. What was a normal year for you, and now compare it to what it is now. I love this one. Is payroll expense paid to an accounting firm for processing payroll included in allowable expenses?
Well, I guess now that we have covered operations expenditures, it's included there. It is not a payroll cost, however.
Right. It's not a payroll cost, but I believe one of the criteria was that if you're paying your accountant for payroll processing, so all the CPAs that are out there that are not with them are going to mark their bills payroll processing, and then they're going to get paid. They're going to get allowed our clients to get paid. I don't know. Just thought that was kind of funny. Let's move along here. Oops, sorry. I always mess this up. Let me move on down to the next one. I think it was said, making the note that The 60-40 payroll expense split still applies to PPP2. The answer is yes. Same criteria as PPP1 in most instances. Let's move down a little bit. Is the payroll expense paid? Okay, we got that one. Someone asked that twice. Cannot have two loans same period, correct? If one applies now for PPP1, how long to wait for PPP2? Heard 90 days, which takes you beyond March 31st, deadline if not extended. And Gerald, yes, I heard the 90-day too. I can't find it anywhere in the law, but I did read it. What I believe it said was you could not, if you have to wait 90 days before you apply for the second loan. So what I took that to mean that if you apply for PPP1 right now, you will not be able to apply for PPP2. So that would not, you would not have enough time, because right now PPP2 expires on March 31st. But as we saw with PPP1 that expired, it was opened up again for another couple of months. So depending on what happens with this vaccine and where we are, they could extend that date. But if you have not applied for PPP2, you can't apply for PPP2 without applying for PPP1. So that's the process that you have to go through.
The way to say that too, Frank, is if you want a PPP loan, that's irrelevant to you. You should always apply as soon as you can. And so the only thing is, if you want a PPP loan, apply for one immediately, and maybe your lender will get you two in time. Maybe that 90-day rule does not apply, and you can get both. So there's no harm in applying. You should always apply early. And if you apply early, there's a chance you'll get the second loan. If it's extended and you meet the 90-day rule, you'll get it. If the 90-day rule doesn't apply, you can get it possibly before the March 31st deadline.
Right. And in order to apply for PPP2, you have to have spent the full loan on allowable expenses by the time you receive the PPP2 loan. Not when you apply, but when you receive the money. So if you believe you're getting the money next week, you need to spend all that money this week. If you didn't get PPP1 for partners because you got approved before the rule came out in April, however, how do you do this? So I guess the question here they're asking is, if you prepared PPP1 and we're told that the partners are self-employed individuals and they have to apply on their own, and you got the money already, what do you do? Can you apply for PPP1 again for the difference? You guys agree? Yes. Yes.
Yes. Yeah. You can upsize the loan. You can apply to upsize the loan.
If the bank will do it.
What was that?
If the bank will do it.
If the bank will do it. Yeah, that's the question that Lou has brought up on many of our calls, is some of the banks are saying no, that they're not accepting the upsize, if you will. But yeah, the classic reason you'd want to apply for upsizing your PPP1 was that you applied early on when everybody was thinking that you could not add partners in there in the calculation. So that would be the classic way you'd want to go back in. But again, not sure, and we don't know the answer to this, is if you apply right now for PPP1 upsize, can you apply for PPP2 at the same time? Don't know that. Something that you talk to your lender and see if they'll accept that. With COVID guidance, would this include our employees taking separate trucks to job site fuel costs? So if somebody's taking their own truck now to go to the job site rather than to the office because of COVID, can they use the fuel as an expense? Under utility expenses, I assume.
Under utility expense, it's not includable. I was trying to figure out whether or not it would fit anywhere. Luce, do you think it fits anywhere else?
No, all I can say is we really haven't got any clear guidance on transportation costs that are listed under the utilities. I would say to be cautious, I probably would not include it, but again, as we've seen for PPP1, hopefully we'll see the same thing for PPP2. Payroll costs should be the lion's share of your expenses and what ends up being forgivable. So keep in mind that as you move forward, you're over a 24-week period, by far your payroll costs will exceed your loan amount. That probably will be the case. What is it? A certain uncertainty, but you definitely will have enough coverage if you're doing it right with your payroll costs. So hopefully you won't have to get into these transportation, utility costs, other non-payroll costs.
Yeah, I have yet to see a client that had to rely on utilities to get full forgiveness. I'm
Yeah.
sure they're out there. I just haven't seen it.
Most of the time we see it's payroll, just regular gross payroll. Sometimes they're adding in health insurance or they're adding in the 401k contributions. There was a procedural notice that was issued. I don't think we covered it in our presentation, that went out if you got excess amounts. So again, what typically happens when we're looking at a forgiveness calculation and we're being told from the borrower that they had no FTE reductions, and they need to go into these other costs to use the full amount of the loan in 24 weeks. As an auditor, I look at my analytics and I say that doesn't make sense. I would have thought you would have covered it with all payroll if you have no reductions. So maybe you got too much money in the first place. So there's a procedural memo that went out mostly to the lenders, what they need to do if they catch this as well. So if you have gotten too much money, you need to obviously pay that back. There's a way to do it on this loan, this PPP2. We're still not sure, working through the mechanics on that, but please keep that in mind that they are looking at that. Since they put out a procedural rule, the SBA knows that businesses got too much the first time, especially with all the IFRs that went out and the FAQs, that there are probably businesses that receive too much money inadvertently, not on purpose, but they want the money back. Let's see, if you have PPP1 funds remaining, can you use it now to pay rent that was not paid during the covered period, even though it will not be forgiven since it was not paid or incurred and paid at the next pay date during covered period? So it looks like they didn't use all the money, and now they want to just roll it in and pay all the rent at one time.
This is interesting because it will, I think the question actually said it's not going to be forgivable, but the rent expense is an allowable cost under the PPP. So yes, even though it's spent after your covered period, you could in theory use it to substantiate that you have spent all of the funds. Right.
I agree. I had a question like that, Matt, and what my thought was, as long as but you still have to meet that 60-40 ratio. So yes. You can't just say I got 50% rent, so I'm going to pay I'm going to pay 50% of payroll and then have 50% rent be the total of the loan. You're going to get that denied. So you want to keep that in mind as well. But what the rule said was that you must spend the money, full amount of the loan, prior to receiving PPP2. So obviously that's outside your covered period because most covered periods ended in October. And you also don't have to have full forgiveness in order to get PPP2. You could have had FTE reductions that reduce the amount and you have a loan, you can still apply for PPP2, at least if that's what we're seeing. Let's see. Are there details for the 300 employee limit? Is this 300 at a particular time? Is it 300 FTEs or 300 whether part-time, full-time?
It's a great question, and there's an inconsistency in the guidance. One of the FAQs we found, Matt, you're the youngest person on the call. You may have the best memory here. One of the FAQs said something about you take the average monthly tally to determine your number of employees. When you just look at the application, it talked about, I think it said eligible. Is this the one that said eligible employees, something like that? And so it's the guidance, the IFR, which is a regulation issued by the SBA, talks about average monthly, and the application talks about eligible employees, suggesting you just take a raw count. So we think, without getting into, if there's a conflict between the two, we think that the regulation would control.
Right. Yeah. So the FAQ, it's number 14 in the list of frequently asked questions, and it essentially says that the borrowers can use the average employment over the same time period that they used to do their calculation, or the 12 prior months, right? So, and that's a number of employee counts, so that it's not FTEs. Another note, while we're talking about number of employees, that I think is important to identify here, because we've gotten quite a few questions, and I saw a couple as we scrolled through, is how do the affiliation rules apply? And the tests for eligibility, which include the number of employees and the gross receipts, are done at the affiliated level. So you would need to combine all the affiliates unless you have a waiver of affiliation. The waiver of affiliation is NAICS code 7.2 or franchises. So yeah, so it's going to be an overall number as opposed to an FTE. So for purposes of eligibility and applying for the loan, you throw the idea of an FTE out the window. You use the number of employees, and then we bring FTEs back to calculate for loan forgiveness.
Okay, let's take some more questions here. Is the new forgiveness application for loans under 150,000 available yet, or do you know when it will be made available?
It's now available as of 2 or 3 days ago. It's online on that portal we talked about, Treasury PPP loan. And it's a one-page certification rather than numbers, and it's there.
Okay.
Again, Frank, the key is the banks have to have it up on their portals. So
Right.
You can go through the application, you can print it out, go through it, but you're going to have to work with your bank to make sure they have the application up and running. Right now, I think it's limited to under 50,000 for the simple 35.
Right. And I think, Lou, you mentioned that some of the banks halted the forgiveness application, accepting forgiveness applications until PPP2 is done. Didn't you mention that to me?
No, they've suspended the PPP1 forgiveness applications until they get a handle on the PPP2 borrowing applications. I don't think it's going to be that long, but you may find that your bank is not accepting the forgiveness applications at this point. So you'll have to be patient and make sure you stay in contact with them.
Mm-hmm. Okay, let's see. If you want to take advantage of the ERTC credit in 21 and have PPP2, maybe we need to be strategic about keeping payroll and 60% and then looking to use other costs. So I guess this means, managing your payroll costs.
Yeah, I think they're getting at to avoid double dipping. They want to include more non-payroll costs on the PPP to minimize the payroll on the PPP so they can allocate more to the ERTC. And that is one, that's a good strategy to make sure you're not double dipping the payroll, especially if things are tight.
So how would you document that somewhere, Dan? Like you're using the first, if you have 24 weeks of payroll that you took, or whatever period, and you decide that you only needed 20 of those weeks, do you cut it off at 20 weeks, or do you just cap it at a certain dollar amount and say that's all I used? And
yeah, I think you would do what we were before the PPP was tax-free. We were advising clients to prepare an allocation statement on their PPP application and to talk about how they were allocating the wages and other items because it had collateral tax consequences. That's no longer an issue, but it's an issue here. So you would file an allocation statement or just a statement with the bank saying we are using wages from the following time periods, and that's so it's clear what wages went on the PPP forgiveness application, so those wages are not duplicated for the ERTC.
Yeah, and by the way, the new applications that were released, when they talk about the definition of cash compensation, they now indicate do not include any costs, any payroll costs that were utilized to obtain an employee retention tax credit, right? So I actually, I prepared one of these over the past week or so, and what we ended up doing was lining up all of the payroll periods for each employee and segregating between the different programs so that we could clearly identify which amounts related to the PPP, which amounts related to the employee retention tax credit, and which amounts weren't eligible for either program.
Yeah, you can always do it after the fact. To the extent you have a contemporaneous allocation, it's probably a little better. So just, it's not necessary, but it would be helpful if you file a PPP application. It also better to do the work now so you have it rather than do it if you're audited on the employee retention tax credit. So do that segregation that Matt was saying today when you file your application for the forgiveness.
Here's an interesting question. What are your thoughts on delaying applying for PPP2 loan until near the end of Q1 of 21, so that the majority, if not all, of 21's Q1 wages would go towards the ERC? And then once PPP2 is funded, switch over to using the next 8 to 24 weeks towards PPP2.
I guess the answer to
worked.
that is, yeah.
That worked, but they may run out of money. That's right.
Yeah.
We went through this with PPP1. Everyone wanted to delay when the employees were not working. Say, let me delay it so I can actually use the money when my employees can work.
March 31st is the deadline. So, I mean, at some point you would be eating into your second quarter, credit. So, I don't know, it probably would make more sense to segregate your payroll. Again, the one thing we talked about before, at 24 weeks, you should have plenty of payroll for both your credit and your PPP loan forgiveness. So again, there may be some instances where that's not the case, but again, over a 24-week period, there should be plenty of opportunity to use payroll for credit.
Yeah, as everyone said on just now, waiting, you don't know if they're going to run out of money. And my understanding was on PPP1, the banks were allotted so much money. So some banks hit their threshold. I think there was one bank that was on the bad list with the SBA. And so they only got allotted a certain amount of money and they ran out pretty quickly. And again, and the other thing that, I don't know if this was asked on here, but applying through your bank, your current bank, or let's say you got the loan from bank one, should you go back to that same bank to get PPP2? Or can you go to a different bank to get PPP2? What are your thoughts on that?
I don't think there's anything that precludes you from going to a different bank. It may be more difficult to get the loan.
I heard one client.
Obviously, they like you to have an operating account, with the bank. If you use your primary bank for PPP1, then you have your operating account with them. You might have to have a separate account open, depending on the size of the loan and how easy it is to move money between banks. It may just be a mechanical issue. There shouldn't be any restrictions in terms of whether you can use a second bank or a different bank or not.
Yeah, I heard one client told me that their lender told them they won't process a PPP2 loan. They said, unless your account is with us, your primary account, we won't do the loan.
Yeah, I'm an auditor just like Frank. So the one thing that I would recommend here is think about any covenants you have with your current bank. If you go out and get a loan, I mean, the PPP facility is a loan. So if you go out and get a loan from another lending facility, are you in violation of a covenant with your primary lender? So think about that as well.
For the ERC credit in 2020, business was shut down for 60 days. We don't meet the gross receipts threshold. Do we get the credit for the entire year?
The answer, guys, it's been a while since I had these questions. It goes back to, I believe it's during the period of the suspension, the partial or full suspension, or the period when you have the decline in gross receipts, except, to the extent it doesn't recover to that 80% level.
Right. Okay, I like this question. Can an S Corp with no payroll cost, i.e. the owner takes distributions only, be entitled to a PPP loan? So they have no wages, the owner just takes a K1 for ordinary income. What do you guys think? I know what I think. Go ahead.
That would be a Schedule C owner, right?
No, S Corp is a corporation.
Oh, I'm sorry, I didn't hear
S
that.
Corp, yeah.
Yeah.
I don't see how.
It's just a distribution, right, Frank?
Yes, just distributions. That to me, is one of the reasons why you don't have your S corps. Because what's happening is you're avoiding paying Social Security tax. And I remember when I did taxes way back in the day, I made sure all my S corp owners took some sort of a salary, because number one, they paid into Social Security, which helped them when they retire. And number two, the IRS could come in and deem those dividends and not and have you pay dividend income as well on it and not get a deduction. So or whatever, I'm not sure exactly how the term is, but I know that that was not appropriate back then. So yeah, so if you did that, and that was your game plan for strategy for not paying Social Security tax, unfortunately, you're going to be out of luck for getting a loan.
Frank, what's 2.5 times 0?
It's $1,000.
Right.
Let's see. Do the safe harbors for PPP1 continue to PPP2?
Yes.
Yeah. Yep.
Everything's the same, right? As PPP1 to PPP2, pretty much on the FTEs and all that for forgiveness purposes.
Pretty much.
Okay. Let's see. I'm moving up a little bit here. Any chance I'll ask a tax guy who's an attorney. Any chance of an individual home office deduction for employees of shuttered businesses who are working at home? So we didn't really cover the shuttered venue, but I guess they're looking to take their home office as a deduction for that expense.
As a
No,
payroll.
I don't know the answer to
As probably an operating expense. And I think what, and I'm not sure where I saw this, but well, this was covered when you had Schedule Cs. If it was deducted on the Schedule C of the individual, you typically could take that same deduction or use that same amount for forgiveness purposes. So you know, some of those costs that we had when you were Schedule C, and I'm trying to offhand, can't remember exactly, but there were some costs on Schedule C. If you took it for Schedule C purposes, then it would qualify towards your cost for forgiveness.
Wasn't there a rule for home-based businesses that said you can't take personal your household expenses? I thought there was a rule there. I'd have to check. I don't know offhand.
Yeah, I have to check. I thought that rule was, but if you deducted it for your tax return purposes, you can use it for the PPP forgiveness. Because you had to use, you couldn't just come through later on and say, oh, I have this home office, let me take those expenses. It was if you took it on your tax return, then you could take it for forgiveness. That's what I remember on that. Let's see. Do we add the covered operating expenses, utilities, rent, and covered protection expenditures on top of the 2.5 average monthly payroll calculation to determine the loan amount? No.
Loan amount is strictly based on payroll costs. Payroll costs times 2.5.
Right. You can't get all the other costs, but you can use those costs when you're looking for forgiveness. That's the added benefit because they are giving you 2.5 months, and originally this was an eight-week payroll covered period. So 8 weeks, 2.5 months was 10 weeks pretty much. So they were giving you those half a month was really to cover the overhead costs. Now you have 24 weeks, so they're really trying to get you to get the payroll out there. Let's see if we have any more questions here. Do qualifying wages for the employee retention exclude wages funded by Treasury's payroll support program?
I don't know what that
PSP,
program
not
is.
PPP. Yeah, I don't know. This is PSP funds are meant for airlines and airline contractors. Don't know. I don't know that. We haven't really dealt a lot in the area of airlines. We have 1 or 2 clients, I think, that are airlines, but we haven't gotten too much in that area. We are a nonprofit. We have been using consultants and temp agency people instead of adding to payroll. Are those expenses covered under forgiveness?
No, in general, they have to be your own employees to count as payroll costs.
They have to be W-2 employees.
Right. Here's one on number of employees. Does the threshold of 300 employees apply to businesses operations in the US or takes into consideration the employees of parent overseas.
You have to look at all affiliates when you test, even the non-US employees.
Even though you can't use payments to the employees overseas that are U.S. residents, but they're residing in a foreign country. You can't use their payroll for forgiveness, even though they're U.S. resident. Correct? Yeah.
It's because the affiliation rule brings it in. Once they're an affiliate, it brings in the employees.
Right, for the head count, and it has to be 300. Yeah. When you're going for forgiveness, you can't count those employees paid out of the U.S. So,
right.
Regarding the 25% drop in gross receipts, does the gross amount of the sale of assets include investments that were sold? And the answer is no, not for a for-profit entity, but as I mentioned, it looks like for not-for-profit entities that have sales of investments, looks like that counts as gross receipts. Not sure why, but that was the rule there. Let's see, do 501c5 organizations qualify for PPP as silent, not call out or designated? Various lenders and regional SBA have said yes and no. I don't remember 501, I don't know what a 501c5 is. And I know 501c6s are allowed. Dan, we don't hear you. Oh.
Right, I thought they added 501c6s. I don't recall seeing C5s.
Correct.
Yeah. It may be, I just don't know. We have never looked into that point.
Okay, let's see what other questions we have in here. If you already received PPP forgiveness in 2020, can you amend the PPP forgiveness application to reduce the payroll costs and include more other costs to increase the ERTC? So basically, can you amend the form you already sent to the SBA, to the bank, and they already sent it to the SBA?
My guess is no. I mean, once they've forgiven it, I can't imagine they have an appetite to reopen that.
No.
Probably
and
not. Check with your bank. Ask your bank.
Yeah. Ask the bank. As you saw from another question, it's 4 months later. They're still waiting for the SBA to give them a response. So, the chances are, would you even get it back in time before you have to start making your first payment? Because remember, you have to get forgiveness before that first payment is due. Otherwise, you have to start making payments. So, let's see. If my employee total remained the same during PPP1 commitment period, but decreased between the time the PPP1 commitment period, naming covered period, expiration until the time of PPP2 application, what employee numbers would apply for PPP2 loan forgiveness? The old employee total or the most recent updated employee total?
Well, you're going to have a 24-week period, right, of whatever your FTE count is during that 24-week period. It's going to be compared to the look-back period. So, depending on if your count's down, you may have and you have to use the long form, you may have a reduction. Again, it's probably a question that we can address as you move into your covered period, but there are a lot of exclusions, as we all know, for your FTE count. So you may qualify for some of the exclusions and be allowed to use perhaps the easy form or not have a quotient issue for your FTE count with the long form. Long answer to a short question.
That's fine, that's good. Here's a good one. Can you cover again who should use form 3508S or 3508EZ? So it's the EZ or the S form?
I'll make it simple for you. Anybody with a loan below 150,000 can apply for forgiveness using the S form. Anything over 150,000, you can use the easy form if you meet the certifications that we talked about over the last several months, particularly the economic activity or your FTE count hasn't changed. So the 150 is the mark in terms of whether you can use the S form or the easy form.
There's a long question here on S corporations, sole employee, gross revenue is 200,000, no net income for a decade, no payroll for a decade, but they have a contract. I guess they pay an independent contractor $20,000, and then it goes into a lot of stuff here. So Joe, and it's asking the question: is there any PPP program you can utilize? Well, there's still the EIDL loans out there, so you can look for an EIDL loan that has to be paid back. But if they need money and that's where they want to go, they can do it that way. But unless you have payroll and you could substantiate the payroll, you're not going to get a PPP loan. Independent contractors, 1099s, are not includable as payroll because they can apply on their own. Let's see. Any other questions? We're almost out of time here. I think we covered just about all the questions. Is there anything new that came in since I was talking?
Dan, do you want to talk about state taxes at all, or that's for the next seminar?
The next one, yeah. I think we're putting together a chart. We're in the process of putting together a chart on state conformity, and that should come out in the next couple of days on the website, I think.
Okay, great.
So here somebody said, my lender today sent me a very simple application asking for the quarter that has 25% reduction of gross receipts, and they will process the Ppp2. Great. And that's what it's, I mean, basically you have to just, the form, the application form, it's whatever the bank, the lender requires, but it will have somewhere in there that you have to prove the 25% reduction. So it might be as simple as just tell us, we have the forms are online, you have to indicate on the form, issued form, the government issued form, you have to indicate what quarter it is, but the bank just says, just send it to me, we don't care which quarter, just prove it, then obviously you follow what the bank's asking you. At the end of the day, the bank kind of rules.
If you think about it, Frank, the bank has all the information they need except for whether you had a reduction in that 25%. So they can pre-populate pretty much the entire application except for that 25% gross receipts.
Right.
Sort of.
Right. And pretty much I look at it gross receipts on a cash basis because you can pull your bank statement, see what went into the bank for 3 months versus 2020, and it's pretty simple. That's, hey, here's the cash I got in. So cash basis would obviously be the best way to substantiate that.
Hey Frank, we did get a question in here as I was scrolling through that asks about the term of the loan and whether or not a borrower who received a 2-year term on their first PPP loan and it's not going to get the full thing forgiven can expand that to a 5-year term. And our understanding based on the Ppp Flexibility Act that was signed into law back in June is that the lender and the borrower would need to discuss that, that it is up to the two parties to determine it. There's nothing that legislatively mandates it if your loan was issued before June 5th, but that the lender and the borrower could come to that agreement, and they should be amenable to it.
Mm-hmm. Agreed. The question here, did you just say the loan forgiveness must be done on the bank website and you can't just give the filled in form to the bank? Depends on the bank. Most banks require you to go into their portal and fill out the portal that they set up because they're also going to want some documentation to substantiate it. If it's just like the 3508S or the 3508EZ, there's very little documentation you have to give, but the bank will probably have their own form that they're going to give you. You can pre-prepare the form before the portal is open. This way you go in, it'll make it much quicker for you to go in and put the numbers in. Dan, were you going to say something?
Yeah, I was going to say the reason for that is, as we all know here, is that the SBA has an online portal. That's so the banks have to submit an application to the online portal, so they don't want to have to transcribe your paper application, put it into a digital format, and then transmit it to the SBA. They've automated the process. That's why it's an online portal.
Right. Okay. Can PPP2 be used retroactively? Say, for instance, that PPP1 was all used up in August. Can PPP2 use for September on? No. Basically, you start, your covered period starts the day that you receive the funds. So for PPP1, if you received the money on May 1st, you had May 1st and 24 weeks out. PPP2, you're going to get the money on February 1st, and that's my birthday, and you will have 24 weeks to use that money at that point. So yeah, so you can't go back. There's no looking back. Good try though. And be honest with you, my thought on that would be, why not? Because really, the first PPP1 didn't cover your losses in 2020. It only covered 8 weeks. What about the rest of the year? You know, so now they're making you take the money and then use it going forward. But at least you probably, if your business has started up again in 21, you should be able to easily use it all for payroll. So you're able to use a period in 2020 that had a 25% reduction, get the money, and then use it going forward. You should be able to use 100% of it just for payroll and not have to use the other costs. You guys see any other questions on here you want to? Go ahead.
Let's be perfectly clear about this.
Sure.
You have to spend all of the PPP1 money before you can apply for PPP2. You know, that seems to be a reoccurring question. I don't know if we didn't clarify that, but that is the qualifier. And the new program starts with the start of your covered period. So whenever your covered period starts, that's when you start looking at and accumulating payroll and payroll cost for your PPP2 forgiveness.
Mm-hmm. Yeah, that's a very good point. And that is a question we were getting asked a lot. And I actually had a client call me up because they didn't spend all the money because they were closed. And the point I'll bring up, as I mentioned before, PPP, Payroll Protection Program. So businesses that closed in 2020 that were not able to open up a restaurant, what the government envisioned was that you were going to take the money from this PPP loan and hand it to your employees while they sat home watching Netflix. That was what they wanted, because they didn't want those employees going out and collecting unemployment. So if you didn't use it for that purpose and you kept the money waiting to open and you never opened, well, the government just said, give it back and we're not giving you any more money because you didn't use it in the first place. So that's the government's mindset. And it's pretty clear in the new act that came out, they specific and the IFR especially, it specifically states that exactly as I said it. They don't want you to have the money if you didn't use it all in the first place.
And we all now know that Frank bought Netflix stock in March.
I should have. Oh, I wish I did. Who would have thought the stock market would have taken off like it did? I know I certainly didn't. Hey, by the way, guys, we got a couple people saying we're rock stars. So you guys rock.
Hey Frank, we have one question for the gross receipts king.
Go ahead.
So we have a nonprofit organization that maintains their books on cash basis throughout the year, but prepares an accrual basis financial statement. They don't necessarily file a 990. I guess they don't meet the necessary receipts requirements, but they want to know, can they use cash basis gross receipts to demonstrate the 25%, or do they need to look at their accrual basis cash receipts?
Unfortunately, there's nothing specific. It says the accounting method that you use, doesn't say for what. You know, because again, you might manage your business on cash basis. You know, to have money, I can pay this bill. Accrual is a little different, but you know, you can substantiate. I would assume that on an accrual basis, if you are if other businesses have shut down or you're not providing your services because of the shutdown, you should have less gross revenue in 2020 versus 2019. So I would think that on an accrual basis, you would have less. You also, if you're selling in a nonprofit, you probably don't have a cost of sales. But for a for-profit entity, you know, you have sales. You can, if you're going to get a lot of returns, you can take returns into consideration on an accrual method. Can't do that for cash. But unfortunately, I don't have a definite answer for you. That's kind of, you know, and I know they came out with the IFR and it didn't really get into detail on that. So unfortunately, I don't have a definitive answer.
I
You
get
guys
that a
have
lot,
any
that
thoughts?
question a lot too, Frank, and I tell people just disclose what you're saying,
Yeah.
right? It's ambiguous, and disclosure, you know, cures an ambiguity.
So you're basically saying, so what I would do if I'm a nonprofit, say our cash method, we're reporting on a cash method and here's our reduction for the quarter.
Right, you might also say we keep separate, you know, you got to highlight the ambiguity so they know that's not right. You then say we keep GAAP books on an annual basis, let's say. Because the question I get a lot is, I keep, I'm a cash basis taxpayer, but I do file a return annually based on GAAP. And what do I tell them, you know, if you're going to do that based on cash basis, just tell them this is a cash basis determination. We don't have quarterly results, but we do keep annual financial statements based on GAAP.
Right. One thing you might want to add to that too is that you can say that you manage your business based on a cash basis. So
Yes.
that's why we keep our books, because we manage the business based on cash, and that's how we're reporting this. And then, you know, if anybody comes in at that point, you'd have to, you know, substantiate why you have a GAAP financial statement that's different. But again, GAAP is totally different, and GAAP can make you look good.
Yeah. To quote the infamous Lou Young, the only thing that we know for certain is that there are uncertainties.
We should probably start off all our webinars that way. And we'll quote Lou.
That's going to be the new name of our next webinar. I can tell you that right now.
Yes. So we are getting to that hour where we need to cut this off. So with that said, I will thank you all for attending and listening in. I thank my co-presenters for all their efforts and work, and there's 35 other people behind the scenes that aren't on this call, that are on the call hopefully, but not presenting, that are there to help you all with any questions you have. So, you know, feel free to reach out and we can try to help you get through this these times. So good luck, and we'll probably have another webinar soon as something big comes out again.
Yeah.
Thank you all. Have a good day.